thank you all very much for being here. I think you know where you are, but this is called Investing in a Shifting Economic Climate, the Asia-Pacific Outlook. I'm Sarah Williamson. I am the Chief Executive Officer of FCLT Global, or Focusing Capital on the Long Term, which is a nonprofit that works on capital markets with our 65 members around the world. And I'm thrilled to be moderating this panel this afternoon. So we've had a lot of discussion already at this conference about what's going on in the world, where are tariffs going next, all of those sorts of things. We really want to talk today about the big picture issue of how do we make good long-term investment decisions with all this short-term noise. And in particular, we're really going to focus on three big issues, which is, are these big investors moving money towards the U.S. or away, given all the things that are happening? Are these tariffs creating or eliminating opportunities in the Asia-Pac region? And how do you just make good decisions in an environment like this one? So I'm going to start off by asking my panelists each to briefly introduce themselves. And we've got a couple of things to try to make sure you understand how different they are from each other. The first is I'm going to ask them to talk about the mission of their fund. Is it a development fund, a pension, a sovereign? What is it? How much is internally managed versus outsourced to external managers? How much more or less is invested in privates versus public? And how much is in your home country versus some other countries, as well as, of course, their name and their position. So, Mohammed, let me start with you, and we'll just go down the road.
Sure. Thank you so much. My name is Mohammed Al-Badr. I am the executive director at Mubadala. I focus and head all of our Asia operations, which mainly, I would say, mandated around China, Japan, Korea, and India and Southeast Asia. So that's our main focus areas on the private equity side of things. As an organization, we're a sovereign wealth fund. We're about $330 billion in size. If I were to talk about the portfolio construction, we're probably about 40% in the private equity space. We're probably about 25% in public equities and about 15% in real estate and infrastructure, and the remaining are in alternative investments. In terms of what we have from a geographic standpoint within our country, it's probably about 30% of our portfolio. About 70% is across the world. The majority of that is in the U.S. It's about 40% of our portfolio itself. What makes us somewhat differentiated from other sovereign wealth funds, I would kind of put it around 3 or 4 different items. The first one is we've incubated businesses from scratch internally as an organization and taken them all the way out to IPOs. We've raised third-party capital. So we have something called Mubadala Capital that manages roughly $30 billion and has institutional investors within there. And I would say we have a pretty stable management team that's also there, that's been there for a number of decades. And so this is how Mubadala is crafted, based out of Abu Dhabi, 5 offices. We have probably about 50 countries that we invest towards. And we can do investments anywhere from $1 million all the way out to a couple of $1 billion if need be.
Great. David?
So thanks, Sarah, and great to be back at Milken. So David Allier, I'm the Chief Executive Officer of Host Plus. Host Plus is one of Australia's largest pension funds. I don't know what markets have done today, but let's go with $140 billion AUD. We're an incredibly well-diversified superannuation fund. Often remind my American colleagues that when you think about Australian-style pension funds, don't compare us to US-based pension funds, so defined contributions, schemes. We're probably more akin to an endowment fund. So there's no asset class that we're not interested in exploring. We're largely running 60-40 portfolios, so 60% quasi-listed. That does include a little bit of cash, and 40% unlisted. We are largely outsourced. So there's an interesting experiment happening in Australia. A lot of the large pension funds are moving towards internalising their asset management function, so to some degree becoming asset managers in their own rights. Our strategic position at the moment is that we'll remain outsourced.
Right. Kate?
Thank you.
Thank you. Hello, Sarah, and of course it is lovely to be back at Milken. Lovely to be back at Milken with David as well. So I'm Kate Galvin. I'm the CEO of the Victorian Funds Management Corporation. So we're what's known as a sub-sovereign, so I invest for the future of the state of Victoria in Australia. We're $93 billion Australian, and we're 60-40, a bit like my colleague or my peer over here, so 42% in private markets and the rest in public markets. We are doing an interesting experiment across lots of the investments in Australia where trillions of dollars are invested, but we actually have 37% of our portfolio is invested internally by the team. And we have 45%, we have a home market bias, so we have 45% of our portfolio is invested in Australia across different asset classes, 55% of it overseas, and interestingly, 38.5% of it is invested here in the US.
Hi everyone, my name is Pandu Shahrir. I'm the Chief Investment Officer of Danantara. This is probably the newest sovereign wealth fund from Indonesia. It's about 12 weeks old.
12 weeks?
12 weeks, so still very new. This is our first trip outside of Indonesia, which is here in Milken, so thank you for having us. Essentially, we have two functions. Number one is to corporatize all the state-owned enterprise that is put into Danantara. This includes some of the largest banks in Indonesia, the oil and gas company in Indonesia, the mining companies in Indonesia. All these assets, 845 companies, about $1 trillion in asset, which puts us number 5 as a sovereign wealth fund. The second function is to invest the dividend of these businesses. So these businesses today generate roughly $10 to $12 billion of dividend. For every 1% that we improve on the business, that generates an excess $10 billion of dividend. So in over 5 years, it ranges between 50 to 80 billion of dividend that we need to invest, excluding leverage. If we include leverage in projects, there's probably over $250 billion that we need to invest. Obviously, it won't all be Indonesia. I'm just listening to all of you. I'm trying to learn from all of you. So it sounds good. So most likely we'll do similar. But the main difference maybe is that when we work with GPs, when we work with partners, we just want two things outside of return, commercial. Number one, can you bring knowledge, transfer of knowledge to us? And number two, technological knowledge. So I'll stop there. But thank you.
Great. Vas.
Thanks, Sarah. You're so far away.
I know. Way down there. Hi.
I can just see you. My name is Vas. I'm the CEO of Team Super. Our fund is actually 85 years old, and we were established in 1941 to look after the retirement outcomes for coal mine workers in Australia, which makes a significant contribution to the economy. We've expanded and merged over a number of years, so we also look after the retirement savings of transport workers as well, energy workers. So we have a very heavy manual base. We're definitely not as big as Host Plus. We manage 22 billion AUD on behalf of 150,000 members. We have a home bias as well, similar to Kate. We've got 45% invested in Australia and 55% globally. And we have an 80-20 public-private split within the portfolio. We're not too dissimilar from Host Plus from an investments perspective. We do not manage any of our assets in-house. We have a collection of 55 managers, and we have a team of 15 investment professionals who look after the portfolio through the management managers.
Great, great. So you can see there's some old funds, there's some young funds, there's all sorts of different approaches. So let's jump into how you, as all these different funds, are allocating capital globally and thinking about how to shift that in what's going on today. So Kate, let me start with you. I know you have a large amount of money invested in the U.S. What is your perspective on the changes going on here with the new administration? And is that leading you to be more excited, less excited about the U.S.? How is this affecting flows from outside? Because I think if some of you have been in some of the presentations with the American officials over the last day or a day or two, there may be a slightly different perspective from outside the U.S. Is that fair?
Thank you, Sarah. So, I'm here to see what it is like on the ground, because it is very interesting when you're not actually on the ground to see what plays out in the press, particularly as far away as Australia. So I wouldn't say, I think cautious would be the way that I would sum up how I'm feeling about my exposure to the US at the moment. So at the moment, we're watching the data. So it's really interesting. We're seeing the soft data is looking very cautious and confidence seems to be down, but the hard data keeps coming out and it's incredibly strong. Like the labour market over here is really strong. So our thesis would be at some time those two data points converge, and at the moment it's quite hard to have a perspective on, to call exactly where they will converge. So I think caution is how I would sum it up. We are largely unhedged and we have a large US exposure. So we are starting, and the great thing about being of the size that we are compared to some other people on the panel is we can be active around the portfolio. So we're taking some active positions around the portfolio. For example, we've gone short US dollar, long Japanese yen, starting to think about where do we think there are going to be some safe havens in this kind of uncertainty and volatility. And then I think the other thing that it behoves me to mention is, we are looking at how the US and the current administration are thinking about US institutions and stability. I think all the investors on the panel would agree with me. Stability and certainty are things that long-term investors like, or a bit of predictability. So I'm just watching how the support of US institutions is being supported on the ground here. So that would be the three things I'd say we're thinking about at the moment, Sarah.
Yeah, that makes a lot of sense. David, let me come to you. I know you've got a strong cash inflow position, right? You've got young workers there putting money in, so you've got to put the money somewhere. How are you thinking about putting more money in the U.S. or relative to other places around the world right now?
Yeah. So I probably should have added that Host Plus looks after the retirement accounts of just under 1.9 million people, working people in Australia. So that's approximately 12 to 13% of the Australian workforce. So incredibly important role in that regard. Firstly, it's a great problem to have if you've got cash. I know for some people it is a problem, but it's a great problem to have. And I think from my perspective, and certainly the investment team's perspective, is that notwithstanding that, you need to remain quite disciplined, irrespective of the current investment environment or the economic environment. So it's not that we haven't necessarily experienced various shocks to investment markets. I've been around for quite a long time. I didn't realise we were going to have to deal with a pandemic, but that's now on my resume. So I think the underlying notion of being a genuine long-term investor is something that certainly keep reminding the team about. Having said that, you have to manage volatility. And what volatility generally means is that more often than not, it can present some really interesting opportunities for you. So linking it back to the whole notion of cash, having that flexibility, having that agility to really deploy and take advantage. I don't want to use the word tactical, but it is to some degree tactical positions is something that we're certainly focused on. Specifically in relation to the US, it's been said through numerous presentations, I will never bet against the United States. You can't bet against a country that has high levels of productivity versus the rest of the world. It is a genuine innovator. If what we hear is right, I know the focus is largely on tariffs, but if you believe the story around deregulation in the American, shall we say, economic system, greater incentives to ostensibly further release the economic power, the innovation that is the United States, then I think that only bodes well for the longer term. Clearly, there are short-term issues that we've got to deal with, but we're not getting overly excited. We're not getting overly concerned. We're continuing to deploy cash. We're continually deploying opportunities or seeing opportunities in the United States. Having said that, there are some sectors of the US economy that are overvalued. So we're probably rotating around to areas such as private credit, which seems to be the broad thematic of this conference. We've been in credit for quite a long time. Real assets, we think, is where you want to be. Infrastructure, which for most Australian pension fund investors, we're pioneer infrastructure investors, so we're seeing some fantastic opportunities in that sphere. So we're continuing to deploy. When it comes to China, about 3.5% of our portfolio is actually directly invested in China. But for most of us Australians that are here, if you really want to delve in deeper, our exposures are actually quite significantly higher by virtue of the fact that China is our single largest, export-orientated country. They buy a lot of our minerals. A lot of our hospitality sector is predicated on Chinese tourism. They're back buying our beef. They're back buying our wines, which is wonderful in that regard. So from our perspective, there are still ongoing opportunities within China. So it's not a binary issue when you think about China versus the US. You need to carve out and you need to try and, I suppose, identify those specific opportunities and take advantage of them.
Vas, let me come to you. I know you, David, you just mentioned the Chinese buying minerals. That's obviously what your what workers tend to do. And you also mentioned a few minutes ago that you had a home country bias, but Australia has got this, again, high-class problem that there is so much investable capital there that if you all had a home country bias, it would probably overwhelm it. So how are you thinking about this allocation around the world?
Look, from our perspective, we have considered, at an investment committee level, the changes in the US policy framework over the last 4 months, and probably echoing David's comments, we remain invested. I would suggest that we will not be aggressively investing away from the US. We don't necessarily see Europe, emerging markets, or the UK as more attractive, so we still remain invested over the long term. From a home buyers perspective, obviously our membership are quite exposed to China, just based on the sectors that they work within. That being said, though, like a number of other pension funds in Australia, the level of concentration risk that we have at home is quite high. So whether or not we would look to take on additional concentration risk as a result of what's happening globally is unlikely at this particular point in time. We are obviously keeping an eye on the outcome of protectionist trade policy and how that plays out over the short to medium term. But at this stage, it's not necessarily a wait and see, but we're not stopping investment. We continue to reweight the portfolio, and if anything, the US story for us was probably having less exposure to the Mag 7 because our fund was quite exposed, and our members were quite exposed to that growth. So it drove significant returns for them over a number of years. But again, not to again syndicate David's comments, we feel that that particular part of the market is overvalued. So in our pension book, we reweighted down by about 3.5%, and we actually moved back into emerging markets.
Interesting, great. Mohammed, let me come to you. You invest in private markets, and mostly, and obviously one of the issues there has been the lack of exits, lack of distributions, and so you've got an interesting situation where I'm sure you're investing more money, but the money's not coming out. So talk a little bit about how you're thinking about the money in and out and where that's going.
Yeah, sure. So just to kind of close the loop on the trade part of things.
Yep.
And I think that's probably the most topical thing that's on everybody's forefront of their mind as institutions. I think philosophically speaking, everybody's rerunning their numbers and looking at their assets that are within their books, redoing their base cases, understanding what's taking place and all the data points that are there, and also trying to look at the opportunities sets that are out there. And so you're kind of operating in 3 prisms all at the same time, and taking all those variables in a very fluid situation and coming up with decisions. And so this is what every single one of us portfolio managers are doing today on a constant basis, and it's one where you're always running towards your phone and trying to understand what's taking place, what's coming out of the US, what's coming out of China, what's coming out of Japan, Korea, and all these different locations, and how is that playing into what we're doing. Now for us, as investors, we're long-term investors. And so we invest through the cycles. And so when we look at a place like Asia Pacific, we're thinking about it from a totally different perspective. We think that there's going to be outsized returns for many years to come due to a number of different things. And that's demographics playing a part and role in that. And so this is the really interesting thing, is that you have so many people getting out of the middle class. You have the enablement of technology. And then you have also governments that are becoming much more stable in terms of their long-term policies. This creates a unique opportunity there where I think you can find compelling stories and attractive businesses that you can deploy towards. Now, taking all that into consideration today, us as an organization, we have probably about 13% of our portfolio in Asia. We're looking to ratchet that up to probably about 25% in the next 5 to 10 years. And so what are the key drivers and which markets are they going to be like? They're playing in places like India, right, where there's a significant amount of growth. You look at the compounding growth that's there from a GDP perspective, it's probably around 6-7% on an annual basis. You look at a place like China, that's going to keep growing for another 4-5% for the years that are coming up once a deal happens, if a deal happens in the next few quarters. And then you have places like Japan and Korea, which is slightly more nuanced, and so you have to be very, very specific on where you're deploying your capital there. Southeast Asia, I think, is also playing a great role, and I think there is going to be a shift and a paradigm shift within there, but the depths of the private equity markets are a lot less. And so if you want to do something like late stage and buyout, it's going to be a lot more challenging to do it in a place like that. And so this is kind of the framework that we're operating in within this kind of climate today. And I think it's one where, you know, if you can navigate and be very, very precise about what are the type of opportunities that you're looking for, and get really nuanced in the idiosyncrasies of each one of these markets, you can have a field day. And in this market, I think there are only a number of people that are playing. So it's a very exclusive crowd, especially in the private equity side of things. And so partnerships and teaming up with those partners, extremely important. We operate a very interesting model when it comes to LP commitments. We don't just deploy the capital and walk away. We kind of administer a new way of operating. We call it an unlimited partnership. And so what does that mean? We don't interact as LPGP. I want to see co-investments. I want to do direct investments alongside you. I want to co-underwrite these investments, be a part of the board, do the diligence, top up DD and everything that's around it, and the governance, and build those term sheets and deploy capital. And so this gives us a kind of unique opportunity in a place like, for example, in China or in a place like India, where there aren't that many people that have been very, very successful. And I think teaming up with the right people is an extremely important one through navigating.
That's really helpful. So, Panda, your assets, I believe, are mostly in Indonesia. Is that right?
All Indonesia.
All in Indonesia. So how so as you're putting this thing together, with the understanding it's 12 weeks old, so it's still very new. Do you expect your assets to be in Indonesia for the long term, or are you going to diversify? How do you think about your global exposure? And also, of course, the businesses that you own have exposure as well. So how do you put that together in this global context?
Number one, in the business side, what we want to do is to continue to grow. They're already the most dominant player in our country. And I think now, given what's happening geopolitically, you know, I think the focus now is how to become bigger regionally. And we are looking now in terms of partnership, right, in terms of working with other sovereign funds. So, for example, our 10th week in existence, us and Qatar Investment announced a code GP, where we put in $2 billion, they'll put in $2 billion to invest together, specifically for Indonesia. But how do we work in the industry of healthcare, energy transition? How can we invest and bring best technology and companies into this part of the world? So that's one, right? And I think the way we're looking at some of our businesses as they grow, they have to acquire. One of the things that we're looking here in the U.S., being very open with all of you, is looking how can we increase in digital infrastructure, energy, upstream energy, right, in terms of oil and gas, right, those sectors, refinery. How can we invest? And thankfully, I think we can invest and put that as part of that tariff discussion, right? And I think that's one of the conversation we're having, is how to put capital at work, you know, creating jobs, but at the same time, having political ties. Like it or not, I think all of us have to be upfront about this, that geopolitics is probably top of mind, right? You can play all the numbers, etc., but what happened with the tariff, and that's why it's called tariff war, right? It's a tariff discussion. It does change the way you see countries, the way you look at investment, the way you look at really long-term risk. If we talk about all the positive about the U.S., for example, one of the things that worry me the most is actually what's happening in brain drain, potential brain drain. What's happening between the leading universities? How will that affect? Because I think what's been the best about the U.S. the past 2-3 decades has been the migration of really smart people coming here and creating innovation. Will what has happened recently the past 2-3 weeks, will that reverse that? And what will happen to the rest of the world, and what will happen to America? So if you think long term, one of my big worry is about brain gain or brain drain. So we see it as an opportunity, obviously, you know. So for us, love to have people come to Indonesia and see, right? And how can we invest together in Indonesia? And this is part of it. Part of us coming here is to see how can we collaborate with U.S. partners.
One of the speakers yesterday in one of the other rooms said that 40% of the PhDs awarded in this country last year went to non-Americans. So exactly to your point, it's
it's a worrying trend.
The whole scientific side of things is
we haven't talked about
really
STEM.
critical.
The development of STEM
Right.
the past decade has actually declined the STEM score in the U.S. And will that accelerate, or how will that trend play out?
Right. Really interesting. All sorts of things going on. All right, Kate, you just had elections in Australia, I believe, over the weekend. Obviously, Canada had some elections, a couple of weeks ago. Tell us, especially for the non-Australians in the room, what did that election say? Did it validate? Was it similar to what sort of happened in Canada? And what does that mean for opportunities in Australia, but also around the region? And before I let you answer, we have a QR code, so people who have questions, please take a picture of that, and then it'll come to my iPad, and I will ask your questions too. But I have plenty, but if you've got some, please send them in.
So, of course, Sarah, as a senior public servant, I will not be politically commentating.
Of course.
But for those who are not familiar with the Australian federal and state election cycles, we actually have a really short election cycle federally, so we have an election every 3 years. So it's actually the incumbent government was returned with a greater majority, which wouldn't have been expected, of course, 6 months ago. So very much a similar effect to what has happened in Canada. I think for Australia that is kind of good. So if you have a short election cycle, as long-term investors, stability, certainty of outcome, I think is a good thing. And as someone who has a lot of exposure to Australia, at least I understand what this government, what their aims will be. And, the other great thing about Australia, which other people might not realise, is we have compulsory voting. So we tend to have a very, very centrist government, whatever flavour it tends to be, because we all are required to vote. I have to do an absentee vote before I got on the plane. Otherwise, I would get fined, which is an interesting quirk. But it leads to kind of very different political outcomes from other countries. Not actually that different in Australia, though my fellow panellists might think differently. But so how are we thinking about investing in the region more generally, Sarah, I think is interesting. So we've actually decreased our exposure to emerging market debt and equity over the last couple of years. We took a view that, we've been quite heavily invested in the last 10 years, but actually the return for the risk wasn't really there. So that doesn't mean that a lot of the economies in the Asia-Pacific region are emerging, but we kind of agree with you, Mohammed. We need to be tactical and really drill down into the specific areas that we're going to have exposure to. So in the last couple of years, and I spoke about this last year, we've started to invest in private credit in India, for example. And when I talk to my investment team, my CEO instructs them all that actually if you're heading offshore, it'd be good if you could go via India, because to increase our understanding of that market, where we think there is lots of good opportunity, makes sense for us. We also think that it is about what you know. So getting out more generally in the region, understanding what's at play. So, David, you've already touched on the fact that Australia as an economy is very exposed to China. The China plus one thing is starting to really play out in our region. So we're starting to look at that. I've talked already about, we're looking at Japan, we look at places like Vietnam and things like that, and being really specific about what our exposure is going to be in the Asia-Pacific region. That's what we're really thinking about. I think, and you've touched on this as well, Sarah, the interesting thing we have in Australia is we're just not that big a country with that big an economy, but we have trillions of dollars of pension and sovereign money investing. So, we are starting to hear anecdotally as investors start to look for safety, they're starting to look at Australia, but you're completely right. So if we all start to bring even more home, that's going to be very interesting to see what it does for valuations. So we're quite cautious about that as well.
So Vas, let me come to you. What are you thinking about in terms of interesting opportunities around the Asia-Pac region? You've said before your members are very exposed to China. Does that mean you want to stay away from there? Are there other places that you're thinking about in more detail, or other asset classes? What looks exciting to you?
So as mentioned previously, we are increasing our emerging markets exposure.
Right.
But particularly in the Asia-Pacific region, we do have a very strong home bias. So equities, fixed income, infrastructure, we tend to look closer to home. you'll find that most funds or pension funds in Australia already have quite a significant level of China exposure and to its growth through the mining sector and iron ore. Ooh, it's not.
Sorry.
Okay, yep.
I don't know what that was. Yeah.
Let's keep going. Sorry about that. Don't know what's going on there. But we do recognise the importance of that particular relationship for many of our industries to work. And there is probably I think a broader issue around repatriating capital back home is that there is a confluence of concentration risk and the nature of our equity market, because it is quite narrow. So our equity market effectively is just dominant exposures to materials and banks, and we are significantly underweight technology and growth. So that creates additional risks. So I guess to answer your broader question, through our domestic markets, we have actually significant exposure to Asia Pacific anyway, in particular China. We as a fund are continuing to invest more in emerging markets, and we do, like a number of the other funds on the panel here, have a significant home bias as well.
And when you say emerging markets, what do you mean? Do you mean emerging Asia? Do you mean Latin America? Do you mean Africa, Eastern Europe, lots of other places? Yeah.
Asia, Europe.
Asia. Yep. Yeah. Okay. Great. All right, David, let me come to you. I know you at Host Plus have invested in emerging markets for a long time. And are you continuing that? Are you moving into more frontier China? Tell us a little bit how you're thinking about particularly this sort of emerging market side of the world.
Thanks. No. So firstly, unlike Kate, I can actually comment about...
Oh, okay. Well, you can come back to that then. All right. Let's go back to that. So what do you think?
So incredibly positive to have the Labor Party re-elected. Selfishly, when I say selfishly, certainly on behalf of the Host Plus membership of 1.9 odd million people, to effectively have a government that is determined to maintain the preservation rules around superannuation. That is, you can only access it when two things happen. You either reach retirement age or you die. Take option one, not option two. That's an incredibly positive thing, because it gives us the certainty that we need to continue to deploy for the longer term. And without that, then I would argue a lot of the pension funds, Australian pension funds, would have had certainly been challenged by virtue of the current asset allocation strategies that they deploy. We'd have high levels of liquidity, more short-termism to manage, obviously, drawdown requests. So I think it's good in that regard. But I think even more broadly, the Labor Party do have a genuine plan. I think we can probably hopefully now get some clarity around the energy transition. Superannuation funds in Australia are ready to play an active role, already doing so, but I think we can continue to play a more meaningful role. We have a housing crisis. That is a shortage of housing, like I think many other countries across the world. So they've got a clear plan, genuine incentives to, again, try and encourage the private sector, of which we are one, to effectively invest on the supply side. So I think that's incredibly positive. And then I think the announcements around, and this is important, I think, for the broader world, but a clear plan around unleashing Australia's critical minerals, critical resources. Probably don't need to speak too much about that, but that's been a very important issue in the geopolitical sense. And I think Australia clearly stands to play an incredibly critical role in terms of delivering the flow of those critical minerals and resources that obviously have huge implications for the way our economies are driven. So that's my take on the politics. We have been in emerging markets for quite a long time. It's probably hurt us in terms of a total portfolio return, but we certainly remain committed to it, more so today than probably in the past. To Vass's point, at the end of the day, Australia only represents 2% of the world's GDP. So, today, Host Plus has 40% of its total allocations to Australia. 60% is global, of which 30% is in the United States, and dare I say, growing. And 3.5% is actually China. So it's quite a meaningful allocation for an Australian pension fund in that context. So we remain very positive about emerging markets. Clearly, it will be interesting to see the interplay between China, India, Indonesia, Philippines, Vietnam. So there are a lot of countries that really certainly do stand to benefit as a consequence of the current, tariff wars that have been played out. So I think being well diversified, if I can come back to the notion of diversification, as my CIO keeps reminding me, it's the only free lunch that we have. So remaining fully diversified, having exposures to emerging markets, and we are just about to dip our toe in the water in relation to frontier markets. So places like Bangladesh, places like Kazakhstan. There are a lot of countries that are really doing interesting things. And given the way we generally invest, which is we're active managers, so we employ active managers, high conviction managers. So their job is to go and find the best companies in any country. So it gives them that flexibility. And it may only be one country in Kazakhstan that we can actually get some exposure to. And that's ultimately how we're actually building our portfolio. So we remain quite positive about emerging markets and frontier markets, and we'll continue to allocate, but we're cautiously, allocating money to those regions.
And Mohammed, you mentioned briefly demographics and the role that demographics play in how you're thinking about investing. Can you just go a little bit more into depth in that as you think about the different countries around the Asia-Pac region, or Bangladesh, or frontier markets, or wherever you want to go? Like, how do you think about how important are demographics in your thought process and leading you to interesting opportunities?
Yeah, demographics is destiny. It's that simple. Where things are moving and growth of that is going to create trends. And so you have to be very, very thoughtful as an investor and nuanced about how you particularly look at that. And that's just one variable. There's plenty of other variables that we could look through in terms of how we assess. But if you have an aging population in Japan and Korea, then why wouldn't you want to be doing nursing homes or healthcare? And so these are kind of things that we think about a little bit more as we go through these specific countries and start positioning ourselves. We have probably about 6 sectors that we are thematically globally focused on. Industrials and business services, healthcare, financial services, technology, energy and sustainability, and consumer. And so we as the Asia team, and we have a number of different underwriters, probably about 30 of them as an investment professional team, that are located in Abu Dhabi and Beijing and Hong Kong. And what we do is we typically leverage a lot of our global knowledge from a sectorial standpoint and then bring over the country specific and almost like a matrix model. And so the country team typically has a good sense directionally in the trajectory of what the population and what that's looking like from a demographics perspective. Now, if we start talking about the China miracle, about how 400 or 500 million people moved from, bottom class to middle class over the last 20 to 30 years, it's a massive amount. So what does that mean? So once you move from that lower class to the middle class, you move into a city, right? How does that change? So that your GDP per capita and your disposable income starts increasing. So they move past that $12,000, $13,000, $14,000, $15,000 GDP per capita. And so now they have disposable income. They move from buying, let's call it, goods that are Chinese manufactured, that are more, locally based, to buying a pair of Nike shoes, right? And going to McDonald's to eat. And so we track these habits within the countries and start following where could be the good investment opportunities that have legs, right? And so this is kind of thought process as you're on the ground. And we consistently stay on the ground so that we do know that. And we do have people from each one of these countries to also be able to take away the delta of culture and, I would say, any, misfortunes in terms from a language barrier perspective. And just we have that done. So that's gone. That layer is done. Me, myself, I don't speak many of the languages across there, but I have teams that do, right? And so that interaction that takes place and that flow of information becomes very well integrated, and we can then be able to build those cases in a very, very strong way and do the diligence in the right manner. And so this is what's fascinating about demographics. It's one that's long-term, but there's ways of playing it, whether the population is going down or whether the population is increasing, whether people are moving from the bottom class to middle class or to upper class, and premiumizations. And so we have to kind of figure that out as we're going through the markets and utilizing the different lenses from a sectorial standpoint to really decipher what makes sense and what is attractive as an investment opportunity.
Pandu, teach us about the demographics in Indonesia, which I believe you're probably the youngest country here, right?
Yeah,
I would
that's
think,
right.
by far. So you've got a nice wide sort of pyramid, if you will, of demographics. How much is that driving the way you're thinking about investing, but also the way you're positioning these various businesses that are sort of coming into the organization?
Thank you for asking. Not many people know about Indonesia. It's one of these large countries, and this is a good opportunity to share. We're about 300 million people. I think make us top 4 or 5 in the world, right? Economy is growing well, 5%. Inflation is less than 2%. More interestingly, our President Prabowo enjoys an 85% popularity rating, similar to President Jokowi before. So it's one of the very few transfer of power that is very smooth. In terms of the parliament, it's about 90-something+% within his power. What's interesting about Danantara too, it was the first law that was passed in 2025 in less than 4 weeks that it was passed. So, it's one of the great untold stories is what's happening here in Indonesia. If you look at ASEAN as a region, or Southeast Asia, we make up close to half of the Southeast Asia population. We're probably one of the fastest growing. And we're one of the very few places in the world where both the Chinese and Americans make lots of money. One of the few interesting parts, right? For example, in Freeport, right? We own Freeport. We're the largest shareholder of Freeport through MineID. Freeport is also the largest gold mine in the world, right? If you ask Instagram is number 2. The biggest users is in Indonesia. If you ask TikTok, number 2 biggest users is also in Indonesia. So, what's interesting, that's one story where both Americans and Chinese operate really, really well in one country. And the economy is growing very fast in terms of, if you look at a city like Jakarta, this is a good story for you to hear. I know Australia has 26 million people. Jakarta as a city is 25 million people. There's 25,000 GDP per capita, growing almost double that GDP. It's about 8 to 10%. So if you haven't been to Jakarta, please come and see. It's essentially a world-class infrastructure that's being built there. It's, again, one of the very few mega cities that probably not most people in Milken have not been to. Right? So, one of the things that we want to do is obviously grow the businesses that we have. We want to make them world-class. And for them to be world-class, they may have to come here to Milken to be able to tell their story and their narrative. Maybe some of you don't know. In mining, for example, our MineID is the 6th largest mining entity in the world, right? That's how big and the scale. And all their assets happen to be in Indonesia. I've asked them to look at abroad, look at lithium, look at some of these critical minerals. Go abroad and be able to consolidate because they also have the means to do it. And lastly, Indonesia relatively is very unlevered. If you look at debt to GDP is only 40%, budget deficit is only 2%. Most of the companies too relatively is unlevered. Max maybe 1.5, 2 times debt to EBITDA. We don't take a lot of debt because of the 98 great financial crisis. Because from 1998 until now, most of our companies relatively are unlevered. So it's one of the very few fastest growing economy with not a lot of leverage for that growth and also politically very stable. So that's something maybe just to share. I'm here to market also our country. But because it's a story that most of us and most of the people here in Milken maybe haven't heard of. But one thing that we are trying to do from Danantara is to engage with the world, with all of you, and how can we invest together. Also here in the U.S., I'm actually learning. Well, all of you, I'm like taking a mental note, And lastly, I only have one LP, which is, the country itself. We don't have to sell. We can own the businesses for a very long time. And the only way we sell, maybe if it's a position, is through our state-owned enterprise or into the public market. So that's really the way to engage with us and how to think of us.
Great. That's great. All right, I'm getting some questions coming in here. And again, please send some more. But one here is about the issue of the U.S. dollar. And so the U.S. administration has sort of been talking down the dollar. The dollar has been declining. Many of you, I would assume, account for your funds in your home currency, not in U.S. dollars. So how do you think about the issues with the dollar and the weakening of the dollar, and then maybe even this question of will it be the reserve currency forever? So who wants to start with this? Mohammed, why don't I start with you? Are you dollar based? You're not a dollar based investor either, right? Or
I am
are
a
you?
dollar.
You're a $1
$1
based investor.
We're pegged to the dollar also.
You're always pegged to the dollar.
So the UAE dirham is pegged to the dollar.
So you're the least affected by the dollar.
I am the least, but I am affected on when I'm deploying within those specific markets, right?
Right.
Whether it's in yen or within won or RMB. So yeah, we do take that into consideration in the weakening of it and the way that plays out. But of course, there's a flip side to that, and you can hedge, right? And we typically hedge our principal position when it comes to deploying. And so when it's the RMB and the way that the trajectory is going and it's mapping out towards 7.4 times RMB to dollar, so we'll take those kind of positions very, very early. We have a treasury team that's very well in depth and extremely knowledgeable. We know a lot of bankers across the world, and so we can fixate something with a specific duration, looking at specific curves over a certain amount of time, and be able to invest in that and protect our capital in most cases. And so that's the way that we kind of play a little bit of offense and defense at the same time when it comes to deploying in countries where there is some volatility from a currency perspective versus the dollar. I'll leave some time for some of my
all right. Who else can jump in on the dollar question? David? Yeah?
Well, I'm always reminded that currency is a mug's game. So anyone here trying to predict the currency, certainly the direction of the US dollar, good luck. So certainly from Host Plus's perspective, we do run a currency overlay program. So about 25%, I've got my acting CIO here, but about 24-25% of our international exposures are effectively hedged, and it's not just to the US dollar. Across the board, but beyond that, I think from our perspective, there are good reasons as to why the US would want to devalue its currency. I think it's certainly understood by many in this room, but we're certainly a predictor of which direction that might go.
That's good. Kate, how do you feel about this?
I'm the CEO, not the CIO, so.
Right.
Woe behold me to predict currency. I'm a bit
no
with
predicting currency.
But,
okay,
we'll probably look at hedging more than we have in the past.
Yeah,
that would be the summary of it. You know, we've been unhedged for the last to the US dollar for a long time. So starting to think about how we hedge.
And Pandu, do you have much exposure to the dollar? You probably have a lot of secondary exposure, but most of yours.
Right now, mostly for our oil and gas business and the mining business, but those are dollar takers and also dollar selling. So in a way, natural hedge. In a way, with the idea with the dollar weakening too, for us today, net, not too much impact for now.
Kind of
I'm also more just worried long term. What does it mean for the U.S.? Because it goes back to that productivity question.
Right.
That's kind of my big worry about productivity, because that's always been our constant theme where we're long U.S. is because of productivity. Yeah. So this brain issue, I think, is more serious. I don't think people talk too much about it, but it's something we should be worried.
Yep. Okay. Vas, do you have any views on dealing with the dollar and decline thereof?
Yeah, I think there's a broader U.S. Treasuries picture here. And, we have seen globally a loss of confidence at the margins from a U.S. Treasury perspective. And this was further heightened post-Liberation Day. And as a result, we are more positive about Australian duration from our perspective. However, from our fund's perspective, we're not ready to call this a fundamental realignment from the primacy of US debt issuances and the role of the dollar, given it is still the mainstay and the reserve currency. Alternatives are clearly not at the level that would allow them to fulfill that role, although you will see some rotation out of US debt, particularly for China, given the more confrontational posture of the US, kind of in that respect.
Okay, I'm getting lots of questions now, so I'm just going to pick and choose, so I'm going to ask them too. So Pandu, I think this is for you, which is, can Americans buy real estate in Indonesia? Is it a land lease, and how long? Okay, where you're selling. You got a buyer in the room
I
there.
think,
Good marketing.
Good
today.
marketing right
we're
here.
doing,
That's great
I think,
marketing.
essentially long-term leases. You can buy apartments anytime and anything above $500,000. And in fact, what we're trying to do now is to create special economic zones in Bali. Has anyone been to Bali? It's one of the places where people have gone to Indonesia is Bali. So Bali is actually a perfect place to create special economic zones. We're doing one now in terms of healthcare. We're building a world-class hospitals. Although in front of it, there's a Zuma opening too in front of this hospital. And all of it is a special economic zone, right? And the special economic zone is for people to live and for doing tourism, healthcare tourism. So we see Bali as in a way to attract international talent to come in. And, we had a new law too passing in the healthcare sector, for example, where you can essentially bring international doctors, nurses, ability to buy properties, right, for example. So the hot place is now Bali, Lombok, and those areas because it's just so beautiful.
Okay, look at that. You're selling real estate
selling.
right now.
I'm
Right
doing
now,
selling.
the prices are going up as we speak. Okay, Vas, I'm going to ask this one to you, which is, what role can Asia-Pac play in critical minerals and bridging kind of the demand? And I know, Pando, you mentioned this a little bit too. But the U.S. has a push towards critical minerals independence. The Chinese obviously are doing a lot of sea mining and everything else. Vas, you've got a lot of members in that space, minerals, critical minerals, all sorts of things. I'm going to ask you first. Yeah.
You look at our membership is
I-
quite broad and diverse as
Yeah,
well.
yeah.
We transport, aviation, logistics, waste, energy and mining. We can't have a conversation about critical minerals without just acknowledging how they dug out of the ground. So there are some quite significant ESG sensitive matters associated with that.
Yep.
Look, picking up on David's point, we think Australia has a role to play. From an investment perspective, again, we have 55 managers interposed between us. We are always very cautious about investing significantly or being overweight in the industries in which our members work in as well. So I would say I'm probably not the best person to answer the critical minerals question.
Okay. All right. Well, I'll pick on others with my other ones that I'm getting here. So maybe I'll ask this to each of the other three of you then. What is the most underestimated geopolitical risk today that markets aren't pricing in? David, do you want to start with that? What's the most underestimated geopolitical risk today that maybe markets aren't focusing on?
Well, I think there's always a risk that, most wars eventuate by someone just making a silly mistake. So I just hope that red phone between the various defence ministers, the major superpowers, that's active and that's working. But that's always a real risk, that there's a mistake, a misunderstanding that obviously leads to significant consequences. So I think it comes back to just human behaviour, a bravado. Xi's muscling up to Donald, President Trump. Mr. Trump is doing likewise. Just hope that they can just get all their egos checked and the sensible people in the rooms are obviously across these issues.
So big egos. Yeah, that's
big
good.
egos.
Big
Yeah,
egos.
big egos.
Mohammed, do you have another one? India,
No,
Pakistan, something else? No?
Yeah, that one's kind of on the phrase, and that could, kind of go out of hand. But typically, they have their skirmishes probably every 12 to 18 months, and so that's one that you see consistently and kind of dies out after a certain amount of time. But I'll go to the elephant in the room, and I'll go the opposite of this question and say the big risk, right? So you have two, and this is kind of the continuation of what David was saying. You have two of the largest economies that make up probably 40% of the world's GDP and roughly 30 to 40% of the world's growth. Just for the audience to know, that is a symbiotic relationship. In order for the world to succeed and grow, it necessitates the success of America and China simultaneously. And so when you have a tussle between both of them, then everybody's impacted globally. And so I think this is where, to kind of go back to your earlier point, I think there's going to be more positive than negative. I think that's going to come sooner rather than later, especially if there is dialogue and there is connectivity between the two to unlock a situation and create that agreement between both sides, because it's in the interest of everybody. This is the largest supplier. China makes 1/3 of the world's manufacturing, and the U.S. is the largest consumer, and it makes up 68% of the U.S. GDP. And so they need each other to exist and coexist. And I think this is the kind of thought process that's necessary in order for something diplomatic to kind of open the doors, because all of us investors sitting here in this room today are just waiting and watching that very, very carefully, because that is the one that if it tips over in the wrong direction or it's delayed by a quarter, 2 or 3, then we're all in a big trouble, right? And so I think that's where we're all together kind of pushing for, a good resolution.
Yeah. Kate?
Oh, that was so eloquent. I couldn't say it better.
Thank you.
But it's so true. The longer the uncertainty drags on, the worse it is for all of us who are kind of sitting on the sidelines waiting to see it be sorted out. So
you started with cautious. I've heard the word pause so much over the last few weeks. Everything's paused. Okay, yeah. All right, we only have 5 minutes left, so I'm going to run down the line. Actually, Vas, I'll start with you. So you all are long-term investors. You are trying to meet liabilities way in the future, but there's a lot of noise right now. So can you give us, each of you, give all the investors in the room one tip for how you stay focused on the long term, make those good long-term decisions with everything bouncing around in the world the way it is today?
Thanks for letting me go first.
Okay.
Look,
No pressure.
we all know that seeking to time investments around these types of market events is difficult and almost impossible to do. So that's probably the first thing. And long-term investment or investors are multi-decade investors, and they generally look through political turmoil, as historically we have seen that market resilience rewards patient investment. So that's probably the biggest tip I would have, which is continue to think multi-decade. These things have happened before. Be patient and you will be rewarded. And these things are also very difficult to time.
Yeah, that's really helpful. Pandu, how do you think about this?
For us, number one, in the business side, we're going to move very fast and consolidating to different businesses that we have. But number two, on the investing, most likely will be quite slow, will be quite boring what we do, and it'll be gradual. I think that's one of the 3 things we'll probably do in the next 12 months. There's themes, but I have to think very long term, because one thing that we tend to do as human beings, and we have to do, and we have to force ourselves to do it in our investment practices, is always to think what I like to call the astaghfirullah case, the worst case. That should be my base case, astaghfirullah. Not the alhamdulillah case, which is the best case, right? So thinking worst case that can happen in the next decade or 2 is so important. And that's what I tell our analysts and associates: think worst case. That is your base case. And because we're born optimists, I like to be an optimist. We tend to underprice risk. That's something that I always tell the analysts: don't do groupthink. Think on your own. What will happen 10 years from now, 15? Will there be another tariff war? Will there be real war happening? It is not zero. Taiwan is a risk. We haven't mentioned about Taiwan here, but if it's maybe last year, we'll probably be talking it a lot. War will happen. This is the scary part. The question is when and what will it form? So again, that's probably the only thing, is be gradual, be slow, right? Even though we have a lot of capital coming in, we stay liquid. One of the things that we'll do, we'll just stay liquid. And when the opportunity comes, invest, right? So that's for us.
All right. Kate, a tip?
So my peer has already said diversification is, of course, always your friend, and we are all very long-term investors. I suppose my main tip is to be calm. So, I've been in markets for 30 years. Crises, geopolitical disasters, there's inevitability about them. I had a really interesting conversation with my head of fixed income. We've got a massive fixed income book. We invested all directly. And I said, how are you going? Because it is partly just holding your team to be calm, to remember it's not short-term reaction, not long-term. And he looked at me and he smiled and he said, it's times like this that actually remind you why you work in markets. Because volatility, uncertainty is also opportunity. So it's about being calm, being nimble in the short term, but very focused on the fact that you are there for the long term. So I would be keep calm and carry on.
Keep calm and carry on. That's always a good one. All right, David.
I think it's often been said that long-term patience is a virtue. From my perspective, it's actually a competitive advantage. So, I'm certainly aware of quite a number of funds in Australia who went through a little bit of pain and then pivoted at the wrong time, and that's had some significant consequences. So, I think it's really, really important that you're able to carry all your stakeholders. Certainly in my case, it starts with the board. So having a board that is absolutely clear and management are absolutely transparent and provide the clarity that your boards need, key stakeholders need in order to maintain that long-term positioning. I think that's absolutely critical. It's always good to re-examine your investment beliefs, but ultimately you need to stick by them. So, what got you there in the first instance is likely to carry you through. And I think, as I said earlier on, we all deal with volatility. Without it, it'll be a bloody boring job.
Right.
So I like volatility.
Yeah.
It really does separate out the really good investors from the very, very poor investors. So we should embrace volatility, not get too worried about it, and manage it as best we can.
Embrace and manage volatility. All right, Mohammed, you've got the last word. What
with the shot
what
clock
are your
down,
tips? That's okay.
I feel like Michael Jordan at this.
There you go. You can win the championship right here.
Very simple. I think be thematic investors. So look for the right trajectory in terms of themes. 2, I would say buy cash flows and buy at the right price and at cheap prices. It doesn't matter what happens in a volatile situation if you have a good business that's creating cash flow. And so the markets can go up and down constantly, and that company is still growing on a consistent basis and compounding.
Right. So. John Maynard Keynes said, right, the markets can stay irrational longer than you can stay liquid. Yes, it's a good thing to remember. All right, well, thank you all so much for joining me. Please join me in thanking the panel, and thank you for being here.